Very good morning. This is David. Let's talk about this market. Before starting explanations, take a look of it. Sure, let's dive into a more detailed analysis of the U.S. stock markets as of October 2nd, 2024. Dow Jones Industrial Average DJI. Current level, 42,156.97. Change, down by 173.18 points, minus 0.41%. Key drivers. The decline in the Dow Jones is primarily driven by concerns over rising interest rates and their potential impact on corporate earnings. Additionally, geopolitical tensions and supply chain disruptions continue to weigh on investor sentiment. Nasdaq Composite Comp. Current level, 17,910.36. Change, down by 278.81 points, minus 1.53%. Key drivers. The tech-heavy Nasdaq has been hit harder due to a sell-off in major technology stocks. Investors are cautious about the high valuations in the tech sector, especially with the Federal Reserve signaling more aggressive rate hikes to combat inflation. S&P 500 INX. Current level, 5,708.75. A change, down by 53.73 points, minus 0.93%. Key drivers. The S&P 500's decline reflects broader market concerns, including mixed economic data and earnings reports. Sectors like consumer discretionary and communication services have seen significant pullbacks. Market sentiment. Interest rates. The Federal Reserve's stance on interest rates remains a critical factor. Higher rates can lead to higher borrowing costs for companies and consumers, potentially slowing down economic growth. Inflation. Persistent inflationary pressures are causing concerns about reduced consumer spending power and increased costs for businesses. Geopolitical factors. Ongoing geopolitical tensions, particularly in Eastern Europe and the Middle East, are contributing to market volatility. Sector performance. A technology. Significant declines due to valuation concerns and higher interest rates. Healthcare. Mixed performance, with some companies benefiting from increased demand for healthcare services. Energy. Relatively stable, supported by higher oil prices. Financials. Benefiting from higher interest rates, which can improve profit margins for banks. Outlook. A short-term. Continued volatility is expected as markets react to economic data, corporate earnings, and Federal Reserve announcements. A long-term. Despite short-term challenges, the long-term outlook remains cautiously optimistic, with potential for recovery as inflation stabilizes and economic growth resumes. Economic landscape. Interest rates and monetary policy. Federal Reserve's policy. The Federal Reserve's ongoing tightening of monetary policy, marked by a series of interest rate hikes throughout 2024, has been a significant influence on market dynamics. The central bank is combating persistent inflationary pressures, which, while moderating from 2023 levels, remain above the Fed's 2% target. Impact of higher rates. Higher interest rates raise borrowing costs for businesses and consumers. For corporations, this leads to reduced capital expenditures and weaker earnings growth projections as debt refinancing becomes more expensive. Consumer spending, which accounts for a large portion of U.S. GDP, may also slow as higher rates affect mortgage payments, credit card debt, and personal loans. Inflationary concerns. Sticky inflation. Inflation remains a significant concern for the market. While certain areas, such as energy and housing, have seen some price stabilization, others, particularly food, healthcare, and services, continue to experience upward pressure. Wage growth, while tapering off from earlier in 2024, still contributes to overall cost increases for businesses. Consumer confidence. Inflation erodes consumers' purchasing power, affecting their ability to maintain previous levels of consumption. This is particularly concerning for the consumer discretionary sector, which is heavily reliant on non-essential spending. Corporate earnings and sector-specific impacts. Tech sector sell-off. Valuation pressures. The Nasdaq's more significant decline compared to the Dow and S&P 500 is largely driven by the overvaluation concerns in the tech sector. Major technology companies have experienced exponential growth in the past decade, leading to stretched price-to-earnings (PE) ratios. With interest rates rising, investors are reevaluating the future cash flows of these high-growth companies, leading to a pullback in stock prices. AI and cloud computing. Despite the broader tech sell-off, there are pockets of optimism, particularly in artificial intelligence, AI, and cloud computing. These areas are expected to see robust long-term growth, though in the short term, even leaders in these sectors, like Nvidia and Microsoft, are subject to volatility as profit-taking occurs. Healthcare and pharmaceuticals. Mixed outlook. The healthcare sector's performance is uneven. On one hand, the sector is traditionally seen as defensive during periods of economic uncertainty, which has provided some support. On the other hand, pharmaceutical companies face regulatory headwinds, particularly around drug pricing reform in the U.S. The increased demand for healthcare services, driven by an aging population, is a long-term positive, but cost pressures and legislative risk remain concerns for investors. Energy sector stability. Higher oil prices. The energy sector remains relatively stable, supported by higher oil prices, which have benefited from geopolitical disruptions and supply-side constraints. OPEC Plus has continued its production cuts, contributing to higher crude prices, which in turn boosts the profitability of oil and gas companies. However, these high energy costs could become a drag on broader economic growth, especially in energy-dependent industries. Financials. Benefiting from rate increases. Financial stocks, particularly banks, have benefited from higher interest rates, which improve net interest margins. However, this positive impact is being partially offset by concerns about a potential slowdown in loan demand and higher default rates if the economy continues to weaken. Geopolitical influences. Eastern Europe and Middle East tensions. Ongoing conflicts. Geopolitical tensions, especially in Eastern Europe, related to the Ukraine conflict, and in the Middle East, with ongoing instability in the region, are contributing to market volatility. These conflicts affect global energy markets, particularly in terms of supply, and create broader uncertainty in commodity prices and trade flows. Sanctions and trade restrictions. The continuation of sanctions against Russia and trade restrictions with China, particularly in the technology sector, are creating headwinds for companies that rely on global supply chains. Supply chain bottlenecks, which had been improving earlier in 2024, are again becoming a concern, particularly for industries such as semiconductors, automobiles, and consumer electronics. Key economic indicators to watch. GDP growth. Slower growth expected. The U.S. economy is expected to show slower growth in the final quarter of 2024. The combination of higher borrowing costs, reduced consumer spending, and ongoing global uncertainty is expected to weigh on GDP growth. While not necessarily signaling a recession, the pace of economic expansion will likely be slower than earlier in the year. Labor market. Wage growth and unemployment. The labor market remains tight, but there are signs of cooling, especially in sectors like technology and retail, where layoffs have occurred. Wage growth, a key factor in the inflation outlook, is moderating but remains above pre-pandemic levels, which is a mixed signal for the market. On one hand, it supports consumer spending, but on the other, it adds to inflationary pressures. Consumer spending and sentiment. Discretionary spending slowdown. As inflation continues to impact household budgets, discretionary spending is expected to decline. This is particularly important for sectors such as retail, travel, and luxury goods. The University of Michigan's Consumer Sentiment Index has shown a dip in confidence, suggesting that consumers are becoming more cautious. Market outlook and strategic considerations. Short-term volatility. Economic data sensitivity. In the short term, markets are likely to remain highly sensitive to economic data releases, particularly inflation reports, employment figures, and Federal Reserve meeting minutes. Any surprises in these areas could lead to sharp market movements, either upward or downward, as investors recalibrate expectations. Earnings season. The upcoming corporate earnings season will be closely watched for signs of how companies are navigating the current economic challenges. Companies that can demonstrate pricing power, cost controls, and strong balance sheets may outperform, while those that are more sensitive to consumer spending or high debt levels could struggle. Long-term opportunities. Sector rotation. Long-term investors may look for opportunities in sectors that are more insulated from short-term volatility, such as healthcare, utilities, and select industrials. Additionally, companies with strong cash flows, low debt, and consistent earnings growth are likely to outperform in a higher rate environment. Sustainability and green energy. The energy transition continues to be a long-term theme. Despite the short-term strength of traditional energy stocks, renewable energy companies are expected to benefit from ongoing government incentives and consumer demand for sustainable solutions. The Inflation Reduction Act and other green energy policies will continue to support this sector. Conclusion: the U.S. stock market is currently facing significant headwinds, driven by rising interest rates, inflationary pressures, and geopolitical uncertainties. However, these challenges are balanced by certain long-term opportunities, particularly in sectors like healthcare, renewable energy, and high-quality tech. In the near term,